Well, greetings and salutations, test takers. This is the Series 7 Guru coming to you from my studio in fabulous Las Vegas with what we call our live stream overtime session, where we open up a whiteboard and we go over any questions that people have. Christina has brought up this option question that we're going to do here in a sec. An investor opens the following options position. You write 1 RAN December 35 call at 4. So Christina, I always like you to know contract specifications. And so I would like you to be able to look at that at some point. Maybe it's not tonight, but at some point I'd like you not be fumbling around that that's an obligation to sell the stock at the strike price. And so hopefully, you get good at contract specifications and you know that what that is, what that part of this transaction is. By the way, it's learning a foreign language. So right could mean short. They could have said seller. They could say, lots of things, opening sale. This one, I would hope at some point you can look at this contract and say, this is an obligation to buy the stock at the strike price. And so right off the bat here, I say, okay, this looks like a straddle with different strike prices. A straddle with different strike prices. We call that, Christina, a combination. This is a combination. It doesn't have anything to do with answering the question, but you write a 35 call at 4 and you short a December 30 put at 1.25. So you brought in a total of 5.25 here. Whenever you sell options, the best case is you're going to get to keep the money, right? The contracts expire. You should have not been struggling with the maximum loss here because you should know that if you have a short call, you have unlimited loss potential. So if you agree to sell stock you don't own, that's called a naked or uncovered call. Now, the thing I like to do, and again, this is just Dean, I like to make a T, and I like to track the money dollars out versus dollars in. And I like to, say, okay, what am I looking at? I'm looking at a 25 call. And let's make that a little bigger. And we're looking at a 30 put. And I like to say, okay, so we brought in 4 and we brought in 1.25. I call this my setup. So in terms of the setup, I want to get comfortable with what the contract specifications are. Then I want to get comfortable with setting up my T. And then I also, in this case, what I like to do is I might want to look at the answer set just to see what answers are available to me, right? And so if I look at the answers that are available to me, I can kind of shop around and say, okay, now they say break even points, right? Because this is a straddle. A straddle has 2 break even points. It has an upside break even and a downside break even. So we're going to combine the premiums, 5.25. We're going to add it to the call, right? And subtract it from the put. We're going to add it to the call and subtract it from the put. So we're going to take 35. I have to agree, Christina, that the layout of the question is kind of funky, but what I mean by that is it's kind of funky layout, but it's going to be 35 plus 5.25, which gives me my upside break even of 40.25. And by the way, I could try that out of my T. I could say, okay, well, if I have to buy the stock at 40.25 and deliver at 35, I'd lose 5.25 and I got 5.25. And I could play it out after that. And then I'm going to subtract it from the put. And that gives me 24.75. And again, I could try that out If somebody makes me pay 30 for the stock, which I'm obliged to do, and I sell the stock at 24.75, I'd lose 5.25. I collected 5.25. We have a mnemonic for where we want this to be profitable. And whether it's a short straddle or short combination, I want it to be in between these two numbers. The mnemonic for that is silo, short inside, long outside. So we want it to be in between those two numbers. So break-even point, we got that. Maximum loss is unlimited because of this naked call, right? You're agreeing to sell stock you don't own. And the max gain is you agree to be a potential victim. Nobody victimizes you and you get to keep the money. So the answer to that is A. And let's see what Kaplan shows us. There we go, right? Call up, put down. Tough one. All right, so boom.